Let's Talk Money.
Hello and welcome to another edition of Let's Talk Money with me, Surabhi Upadhyay. Now, you would have seen and heard those headlines: gold crossing 70,000, then 71,000, then 72,000 and 73,000 plus at last count in Indian terms, in terms of Indian prices in INR. Indeed, the gold rush is underway against the backdrop of geopolitical concerns building across West Asia and expectations of rate cuts from the US Federal Reserve. The yellow metal has gained over 15% in 2024 alone, and we're talking just about less than 4 months of the year. Investor interest is rising. To understand the outlook on gold going forward, and more importantly, to understand how we should incorporate gold in our portfolios, well, we have the experts lined up today. We'll, of course, take your queries on the yellow metal as well. Vishal Dhawan of Plan Ahead Wealth Advisors and Chirag Mehta of Quantum AMC are with me on the show today. Gentlemen, thank you very much and welcome to this sparkling golden edition of Let's Talk Money. Vishal, great to have you in the studios.
It's a pleasure being here. Looks like Diwali's come early.
Looks like that. And Chirag, glad you could join us at least, remotely for a bit. But this is that time, this is that sort of a rally which is making everybody sit up and take notice. Those who have gold are feeling fantastic. And those who don't, those who didn't buy enough are having a major FOMO feeling, right? When you see the very sharp pace of rise. So I want to first get your sense on, what you think of the market, what are you thinking of the investing trends, and then we will get to the Q&A from our viewers as well. So Chirag, you take it away because, you are managing a lot of the funds that are there sitting in the gold funds at Quantum AMC. What's the sense? Where has this rally come from and can it sustain given that it has been at such a pace?
Sure, Surabhi. Whenever we have seen a rally in gold, usually you need to see or find some strong underlying economic underpinnings to it. And this time is no different, right? If you look at gold, we have already seen that the headwinds go off. We were seeing earlier interest rates moving up, quantitative tightening from the central banks. So liquidity was being sucked out and cost of money was going up. So those were the headwinds for gold. Now there is more clarity in terms of inflation coming down and therefore interest rates headed lower. We are seeing that, gold is getting repriced. And probably central banks are in a flux. Like, for example, Fed has announced that they will look at 3 rate cuts this year. Now they are in a situation, having been announced that, we are finding ourselves in a slightly more stickier inflation kind of regime, which may be a conundrum for the Fed in terms of what they should do next. So if you see, markets have started repricing in interest rate cut announcements. Earlier, they were expecting 5 rate cuts. Now they have come to terms with the Fed at 3 rate cuts, and probably it could decline even further. Though lesser rate cuts means a headwind for gold, but here we are talking about the credibility of the Fed, because earlier, if you recall, Fed was saying inflation is transitory. I mean, post-COVID, that was.
Right.
Then they said that inflation is we have kind of had a victory over inflation, and now probably inflation may remain stickier to what they expect. So overall, I think these kind of nuances are leading the gold rally, where the central banks are in a flux in terms of what to do, and adding to that uncertainty is probability of an economic slowdown or a financial accident happening because interest rates are very high. And if you look at even this government payment of debt or interest payments on that debt is kind of unsustainable. So I think Fed needs to lower rates, but probably, they might not be able to do so. And that conundrum is needing the smart money moving into gold markets. And that is what is leading. And adding to that is the geopolitical conflicts that we are seeing. So all in all, it's a great level for gold to be in.
Absolutely. Of course, the weekend developments have only sort of, made people really sit up and take notice about what happens from here on in terms of all the uncertainty. Now, Vishal, come in. Traditionally, of course, we Indians have loved our gold. But my question is about serious gold investing from a financial standpoint. Have you seen the propensity to go in for financial products that give you an exposure to gold? What have your clients been doing? Have they been loading up? And have people managed to take advantage of this rally?
Yeah, so I think there's clearly been a sort of good understanding over the last few years that the consumption part of gold needs to be separated from the investment part. And I think gradually as financialization of gold has taken place, I think people have figured that out. I don't think it's prevalent across the board, but I think the more options you have, I think the more likely that there's something that you like, which is outside that jewelry that you wore.
Yeah.
So I think that's clearly happening. I think the way we are seeing it is asset allocations clearly become an important piece. And investors are saying that, between 5 to 15% of gold exposure is probably a good number for us to work with. And I think one of the things people have figured out over the years is that the rupee tends to depreciate against the dollar, and gold is a very natural place where there is a hedge available for Indian investors. And we've seen over the last few years, people spending a lot more money overseas. They travel overseas, they have kids who are going for education overseas, so they're looking for dollar protection as well. So I think this shift has started to happen, where people are starting to allocate. I think, when any allocation point, when you see a 15% rally in 3-4 months, you wish you had more. In fact, you start to ask yourself saying, even is 10% enough or is 15% enough? But I think it's important to keep in mind that this is insurance you're buying on your portfolio.
Yeah.
It's there for the geopolitical risk. It's there for, interest rate movements which happen in the opposite direction of what you were expecting, as Chirag was mentioning. And of course, the central banks are also buying.
Yeah.
So I think there is sort of this realization that has come through.
The question is, how much should we have in our portfolio, and how not to get carried away by price moves, which can look very, very dramatic as they're doing right now. Chirag, just to put in context, retail participation in gold ETFs, gold fund of funds, gold mutual funds, because this avenue opened up for investors a couple of years ago when people like Vishal were explaining to us that we should not consider jewelry as an investment, but look at financial products which give us that exposure. So just tell us what the data says in terms of trends. And in the last couple of months, what have you been noticing with respect to your funds?
So we have seen a steady rise for gold ETFs, especially, whenever we see a rally in gold markets and gold buying becomes essential for portfolios. We have seen good flows coming into gold ETFs, and this again we have seen the same trend unfold this time as well. So earlier last year or so, when there was retail participation in a lull, we were seeing a lot of flows coming because everyone thought that gold is an essential from a multi-asset portfolio, and many funds being launched from that in the multi-asset arena. We saw a lot of flows from multi-asset funds into gold ETFs. And now we have seen incrementally more gold ETF flows coming in. Last 3 months, for example, 660 crores in January, 1,000 crores plus in February, and about 375 crores in March. April is also looking much better, although it's just half a month. We are seeing that momentum continue of more flows coming into gold, despite the price increases that we have seen. So I think individual investors are very underallocated to gold from a portfolio perspective. And I think they are looking at these kind of realizations that, gold is an essential part of the portfolio, and therefore they are coming in. So we think that about 10 to 15% allocation is ideal from a portfolio perspective, and there are hard numbers to prove that, because at that 10 to 15%, you kind of augment your overall portfolio returns and reduce the risk significantly at that level. Beyond that 15% mark, you start giving up return benefit of your portfolio for that added risk reduction that it kind of helps. So I think
so Chirag, allow me Chirag, allow me to quickly move to some questions as well, because they're very connected to what you're saying. I think the whole point is, what do you do now? If you have gold in your portfolio, you're fine, you're sitting pretty, looking at those gains. But what should those do who don't have adequate exposure? So I'll quickly get to those questions. The first query is coming in from Abhay Sharma. He has written in to us, and he's saying, can I invest in gold now for a 5-year horizon, given the current geopolitical concerns? Can I look at gold ETF? So Vishal, I think this is what I'm talking about, right? People are seeing the price rise and realizing, oh, hey, I don't have gold in my portfolio. So what do? Is this still feasible to buy?
So I think you need to go back to the allocation question ultimately and say that, if I'm sort of a very defensive investor, maybe I want 15% gold. If I'm very aggressive, maybe I want 5 or 10. If you're not there yet, you need to build it, but be careful about building it out. I think it's very tempting because of recency biases that are very natural to us to say, hey, let me build that from 0 to 10 or 1 to 10 in one shot. I think you need to be careful. You need to stagger, number one. Number two piece of advice for Abhay is that very, very clearly, a 5-year investment horizon for gold is probably not good enough. I think we need to start looking at gold as a growth asset which delivers outcomes over much longer periods of time. I think we've got it for equity. We've understood it for real estate. I think for gold, we still tend to take a slightly longer term view.
You just said it's insurance for the portfolio,
It
but
is
it's
insurance.
moving like a growth asset
Right,
as
exactly,
of now.
exactly. So, it's a big debate, right? Is it defensive or growth? And I think the way to look at it is buy gradually, buy 5-10%, go up to that level, but clearly have a 7 to 10 year investment horizon at least. Don't just stop at 5.
Okay, fair enough. So you can start buying now. Staggered is the way to go, and widen your time horizon. That's what the advice is. I have a related question which is coming in from Ruchit. Ruchit is again saying he has no exposure to gold currently. Should he begin by investing in gold ETFs? So since he's asking specifically about ETFs, Chirag, I'll open this with you. I guess you probably might be in agreement with what Vishal says. Would staggered be the way to go, considering we're looking at these all-time high prices? And then tell us, why should one look at gold ETFs over a lot of the other options?
Sure. So Surabhi, for like any other asset, gold is also an asset that has volatility associated with it. There will be cycles, up cycle and down cycle. So probably it's best to average over rather than taking a call on prices. So I think staggered, I agree with Vishal that, staggered is the way to go. And gold ETFs, I think they were one of the best financial innovations that we have seen because it allows you at the retail level buying 0.01 grams of gold at a price where tons and tons of gold get exchanged between a gold producer and a gold bullion bank. So that is the efficiency that gold ETFs bring to the table from a very wholesale level to a retail level. And given that efficiency, you don't have to worry about purity, you don't have to worry about liquidity, you don't have to worry about storage. Insurance is comprehensive with these gold ETFs. So all in all, it's a great product to be in because we buy gold for a rainy day. And, if you want to liquidate for any emergency or for any necessary thing, then probably gold ETFs can provide you that liquidity virtually 24/7. Because if you are in a gold fund, you can liquidate at any point in time in a T+2, you will have money in your bank account. So I think it's a great way to invest because, it has physical gold backing to it. At the same time, it is very, very price efficient. So I think, and the most important advantage that differentiates gold ETFs is the liquidity that it provides at fair prices at any point in time.
Okay, so that is Chirag, obviously batting for gold ETFs and gold funds. Fair enough, Chirag. After the break, we'll actually do a deeper analysis of some of the other options as well. But before we let you go, Chirag, just leave us with an outlook. I know these things are tough to predict, and you already outlined a lot of the factors, geopolitics at play. We don't know what's happening with rate cuts, central banks are buying. But all things equal, given the pace of this rally for maybe the next 1 year, are you still expecting more upsides? Or perhaps some consolidation, what's, from a market perspective, what's your call?
So I think there are strong underpinnings to this, which is from an economic standpoint. So I think this rally is here to stay. What will kind of accentuate is what the errors that we see from central banks around the world, whether they are errors or they kind of course correct, that will determine how we think gold prices going forward. But overall, downsides from these levels will be limited. There is a geopolitical premium built into prices. If geopolitics kind of corrects itself, then probably, we may see some subsiding of that premium. But there will be some or the other element of the premium given Middle East have become a bedrock of geopolitics today. And there could be many surprises on the way. So there will be an element of geopolitical premium out there. Longer term, we are very, very bullish. So if there is any dips in gold prices, but that's an opportunity given the dips would be limited, given the inflation trajectory that we see unfolding, and there could be possibly in terms of central banks not being able to do what they have conveyed us to do. So I think we are in a longer term, much better situation when it comes to gold.
Got it. All right, Chirag, thank you very much. We will let you go at this point in time. Thanks for joining in and giving us some perspective. We will take that break, but after the break, Vishal, I want to explore this point about the right products. Now, we all, know that we need to have exposure to gold. What is the best route for that? That's what we'll discuss after the break. So keep it with us. More of your questions will be answered on the other side. Let's talk money. Welcome back. You're with us on Let's Talk Money. And this week we are talking about the shiny, glittery yellow metal called gold, which is hitting new records in terms of the price action. The question is whether you have adequate exposure to gold in your portfolio or not. So Vishal, we have some more questions coming in. I want to sort of straight away get to them. Nidhi has a query. I think she's on the phone line with us. Nidhi, hi. Welcome to the show. Tell us, how can we help you?
Hi, my name is Nidhi. I want to relocate to another country and have some quantity of physical gold. I want to liquidate it and turn it into virtual gold. What is the best option?
Okay, Nidhi, thanks for that question. That's an interesting question, actually, because if we just look at it, sometimes there's a lot of jewelry or other forms of gold which is lying unused, not even being consumed, and it's just lying there. So what would you advise? A, is it good to convert that into a financial form of gold? And then if yes, then what form? Which financial form?
Yeah, I think there's a plethora of choices now, so it's a good place to be in. So I think one of the options is clearly to look at ETFs or gold funds. The advantage clearly there is that it's regulated. And I think this was a sort of missing link in the gold industry. You were always unsure about purity. You wanted to go to a jeweler who you know because you were like not sure whether you'll get stuff that you wanted, etc. Now that you have the ETF option available, you can buy small quantities, you can hold it electronically, you don't have to worry about transport, you don't have to worry about customs duty, none of that. As an investor, I think it's a great option. Of course, you can buy the ETF domestically, or once you go overseas, you can buy it internationally as well. The other option is to, of course, look at sovereign gold bonds. And I think it's very interesting to look at sovereign gold bonds. This as a product didn't exist a few years ago. It's a product that's come in, regulated by RBI. The beauty of the sovereign gold bond is that it is available, giving you some interest. 2.5% a year, paid 2 times a year. A lot of times people say, hey, 2.5% is nothing, right? But the fact of the matter is that people buy houses, which they rent out, on which they earn 2.5% a year as well.
Rental yield, yeah.
That's what rental yields are about. So suddenly, gold lying in your locker, or in some account somewhere which earned you 0, now starts to earn you 2.5%. Fantastic. I think it's a great option. I think for Nidhi, the challenge is going to be that she can only do that while she's a resident. Once she becomes non-resident, not possible to buy a sovereign gold bond. She has to be comfortable with the lock-in that comes with it. Because
there's an 8-year lock-in,
There's an
right?
8-year lock-in. I mean, there is liquidity after 5 years.
Okay.
But typically, the tenure is 8 years.
Okay.
And the advantage, of course, is that it's sort of backed by the RBI. So you feel comfortable. I think there's one element of risk which always exists with any product that is got a particular tenure, which is that you can't control what the price will be at the end of the 8th year.
Sure.
And you don't know, whether it's going to be up, down, whatever. But let's say you have a bad period for gold. It's perfectly okay to take that money and buy another gold bond again. Because at the end of the day, then you're sort of buying at those lower prices at that point.
And there is no capital gains tax as well, right, on these bonds?
Yes, so the beauty about sovereign gold bonds is if you hold to maturity, no capital gains bonds. So very, very tax efficient. So interest is taxable, but the capital gains are not. And that makes it very, very efficient as an option.
Okay, so that's sovereign gold bonds. Just to go back to the gold funds for a bit. So there are gold ETFs where you'll need a demat account. Then there are mutual funds that invest in gold where you don't need to have a demat account. You're not really trading on the exchange. So the pros and cons, and also a little bit about the cost involved, the expense ratios, etc. I mean, and taxation, etc.
Sure. So the advantage of the gold fund is essentially that a lot of people want to buy in a staggered manner, right? Like we were just discussing. Now, gold funds make that very easy because you can set up a systematic investment plan, you can set up a systematic transfer plan from a liquid fund. So you have all that flexibility built in, which an ETF may not provide because it depends on the platform that you're working with, on whether it allows an SIP sort of structure. The disadvantage on a gold fund is that you now end up having a little extra cost to pay. So typically, if you look at a gold ETF, the expense ratios are about 0.5% per annum. That's the cost that you pay for all that benefit that you get, purity, no storage issues, all of those things. A gold fund would probably have an extra cost on top of that, which is on an average about 0.4% per annum extra. So I think the way to look at it is roughly 0.8% per annum to 1% per annum is what you give up to get the flexibility of being able to buy SIPs, STPs, etc., and also not worry about liquidity at all. Because if you decide to sell a gold mutual fund, you will sell it back to the mutual fund itself. And therefore, you will get your money, by default, because mutual fund will create the liquidity for you. whether it's available or
just
not.
one more quick point before we move to the next question. Nidhi's question was also on liquidating current physical holdings. So apart from going and selling it in the market to a jeweler, I remember there used to be this gold monetization scheme as well. I mean, is there any efficient way of getting rid of your physical holdings and then using that cash to enter one of these products?
So I think, the gold monetization scheme is really not, I think, the most efficient instrument to use for what she's seeking.
Okay.
I think it has a different role to play. But I think for her, probably liquidation is going to be the answer, especially if she's going to go there, be there long term. You need physical storage to be there. I mean, you're like bank lockers, maybe much easier to get in India than they are in other parts of the world. So where do you store the gold? Where do you store the ornaments? What do? You pass in through customs on both sides. You have to deal with all of that. So I think it's very practical, saying that, hey, a part of this maybe is family heirlooms. I never want to let go of it. I want to pass it on to the next generation. But I think anything which is outside of that, I think it makes a lot of sense to convert it. You need to go out. Unfortunately, there's no way to do it but to sell it back to a jeweler. But once it's done, and assuming that gold is going to continue to grow over the next many years, you've done it once, and then after that you can be in the financial world with gold.
Got it. Okay, time for just one last question on the show. Ayush is with us on the phone line. Ayush, thank you for dialing in. Tell us, what's your query?
So hi, this is Ayush, and I just wanted to understand, with the recent volatility attached to the equity market, even despite the bullish run, that what would be the prospect of understanding a return of maybe a 2x in the gold investment, and what is the time period we should look at?
Okay, so Ayush, you want a 2x return. Now, given the rate at which things are going, God knows. But typically, I don't know, I haven't run the numbers or the math on this. But, in how much time can gold double, your gold investment?
So I think you need to look at gold from a longer term perspective. It is typically your hedge against inflation. It tends to follow inflation trends very closely over long periods of time. The RBI works with a 6% upper sort of limit on inflation. Maybe your own lifestyle will probably have it go up by another 2%, so inflation's at 8%. So if your inflation rates are between 6 and 8% over long periods, you should expect that gold will also end up tracking that. And if that ends up happening, then your money will typically double over 9 to 12 years. I think that's the way to think about gold. I mean, of course, if it doubles quicker, great news, but...
So you assume an 8% rate of, price appreciation every year, and then you can expect your gold investment to double in about 9 years. 9 years approximately.
9 years or so, that's right.
Okay, that's interesting. So that's a rough math for you to work with. Finally, we didn't discuss one last product, and that is digital gold, which really hit the scene some time back, where you could invest for as little as 100 rupees. And, there was this talk about that eventually it will have the backing of physical gold, and you can maybe, get physical gold when you want to. What did you think of this product, and is it advisable to look at it?
So I think it's a place where clearly regulations have not caught up in that space. So both RBI and SEBI don't look at that. So I think investors buying digital gold are exposed to risk of an sort of unregulated space. The advantage clearly there is that, it just is very, very easy to do what you have to do. So it's convenient. You can buy very small lots, but there are limits on the upper end. So you cannot buy more than 2 lakhs across transactions for even the entire day, even if you split it across. And you'll end up paying 3% GST as well.
Okay.
So I think the way to think about that is, if you don't want a demat account, if you don't like a gold fund, you don't have an 8-year investment horizon, then you may look at it, but you need to be comfortable with the fact that it clearly is extra risk as compared to other places, even though there are players who've come in which are sort of government-backed companies. But I still think you need to be comfortable with the risk.
Fair enough. I think we've put all the options on the table. Now it's for each to decide which one suits them. Vishal, this has been a very, very helpful conversation. Thank you so much for joining in.
It's a pleasure.
And, shining some more light and sparkle on gold and how we should assimilate it in our portfolios. Thank you for being here with us.
Thank you so much. Such a pleasure.
All right. Hope you found this conversation useful. Keep sending us your feedback, comments and queries, and of course more questions, because what you ask is what we answer on this show. It's a wrap on this edition. Thanks very much for being with us. See you again next week.
Let's talk money